Okay, not really a good day today for the market and for Google. I wish I invested a bit more in China because it went up 5% today. But in this video, we're going to talk about Alphabet. Okay, we're not going to cover all the companies and so on. We're just going to talk about Alphabet because there is a big news. I guess that's the reason as well why it's down 3%, okay, which is more than everybody else, okay? So why Google is down 3%. We'll understand this acquisition that they're doing, if it makes sense, if it doesn't make sense, if it's smart, if it's not smart, if it's too expensive, if it's not too expensive. And we'll as well do a valuation, okay, with my spreadsheet to understand at which price can be interesting to buy Google. If I still want to buy it, if I have it in my portfolio, so if I will buy more, or if I will maybe sell the company after the news. So the big news is Alphabet to acquire cybersecurity firm Wiz in cash, $32 billion deal. Okay, after this the stock fall. So Wiz deal with Google mark biggest acquisition ever. Okay, it will be the biggest one, and it will be part of Google's cloud computing business after the deal is closed. Okay. With Wiz, we believe we will vastly improve how security is designed, operated and automated, providing an end-to-end security platform for customers to prevent, detect and respond to incidents across all major clouds and code environments. This is Thomas Kurian, the CEO of Google's cloud. Okay? By coming together, we believe we can help customers to create a stronger foundation for cloud security with a portfolio that solves for tomorrow's requirements. So it's a big bet for the future here. Of course, they want to compete with Microsoft, Oracle, Amazon, AWS. So yeah, that's something kind of big. Wiz is apparently very in advance in tech. So it's a good tech company, it's a good security firm. Okay, that's not the problem. The main problem here is this. Wiz had about $500 million in annual recurring revenue. And even though it's a promising company, even though it's a business that can suit perfectly with Google and Google Cloud, it will give better customer experience, it will be more customer protection. So it's good on the paper. But the thing is, there's two things. First one is, how come Google was not able to build it by themselves with their employees and so on, like companies such as Google? I know it's not their main thing to do security and it's normal to do acquisition in all of this, but it seems that they are pretty late into this security thing, and the fact that they need to buy that much money just shows that apparently they really need this acquisition. They don't buy it to improve everything. They buy it because they need, and they're not able to do it otherwise, because they're buying a company that do $500 million annual recurring revenue for $32 billion. So it's paying 60 times the revenues. 60 times the revenue. It's huge. Okay, it's really big. So okay, it's a startup. It's a company that is small still, but yes, I will not lie, they need it, okay? It's important. Security is important. It's probably one of the biggest markets for the next 10 to 20 years with all the cloud, with all the AI and so on. But is it worth paying this price? I don't know. And it's difficult to know what price is good to pay when you're Google. Because first, you will always have like the Magnificent Seven premium, in a sense that you're one of the biggest companies. So of course, when a startup heard that, oh, Google want to buy you, Alphabet want to buy you, yes, the price go automatically up. Like it's almost automatic. The second thing is, in the hand of Google, the thing can have way more value than in the hand of somebody else. Let's take, for example, Google Chrome. Google Chrome, it's massive value in the hand of Google, like in the hand of Alphabet. But if Apple buy Google Chrome, they cannot buy it for the value that it is for Google, for Alphabet, because in the end of another company, it doesn't have the same value. The application will be totally different. So I can understand that they overpay it, but still, in my opinion, they really overpaid it. Okay, even though like apparently the CEO said, so why this acquisition and why now? Security is a fundamental priority for CEOs and government leaders around the world. but the landscape is changing. The pace of impact of breaches are accelerating. AI brings new risks, but also new opportunities. And at the same time, multi-cloud and hybrid are becoming the norm. Against this backdrop, organizations are looking for cybersecurity solutions that improve cloud security and scan multiple clouds. Wiz is an innovative leading cloud security platform trusted by more than 50% of Fortune 100 companies who already use their product and services. So it's already a used company, okay, 500 million annual recurring revenue, but still, it's big. 32 billion is also in the, like they said it, at the last quarter, the CEO said, we expect to invest approximately 75 billion in capital expenditure in 2025. And I think those 32 billion are kind of included in this. They have cash to spend, okay? They have cash to invest. So the problem when you have so much cash to invest like this is to not burn it, is to make good investment with it. I'm not too afraid about this with Google because the return on investors' capital has been around 30. Okay, 30 is extremely good. When it's over 15, we see that, yeah, it's a great company, the capital allocation is great, it's good. So here, over 30, it's still very good. So I still believe it will be good. I still believe like the company, the quality of the company didn't decline. It's not a problem for them. They can pay it. I'm just like, yeah, it sucks that then you pay 60 times the revenue for a company. But again, in the Google ecosystem, it can still be something very good. It can still be something that will be very useful, will help them to compete better with Microsoft and AWS and Oracle. So yeah, I think on the long run, it will be something good. I don't know how exactly they will implement it, how they will monetize this, if it will mostly be to protect customers and have better customer organization, better customer experience overall, or if they plan like to use it as something that they will sell and that will not be included in the full pack of Google Cloud. I don't know yet. When it's come to value, okay? So if we do a DCF for the next 3 years, this is the cash from operation. So for Google, we don't use free cash flow, we'll not use net income because it's a company that, as you see, it invests a lot in capital expenditure. So we'll mostly value it with the cash from operation. So the average for the last 5-10 years price to operating cash flow is 17. So we'll put 17 here, okay? We'll not have more, we'll not have less. We'll keep it at 17. The cash from operation generated from the last 3 quarters plus the expected quarter finishing, it's 131 billion. We have the number of shares outstanding, we don't expect it to go down, okay? So at 160, if you have a growth of 12%, okay, at this price, you could make 17% per year buying Google. Now, look at the cash from operation. It's expected to grow 17% per year. For the next 3-4 years, it's expected to grow 17% per year. So if you grow 17% per year, and you don't do any buybacks, nothing, you could do 22% with Google. Will it happen? Yes or no? I don't know. But this is without margin of safety. You take a margin of safety, you put 14% here, which is kind of a big margin of safety. You do 19% per year. Now let's go on 5 years. On 5 years, let's say you will not put 17%. Okay, it will decrease. It's too much. Still no buybacks. You say 0 buybacks during 5 years. And it grow 14% per year. Same, we took a margin of safety. You will do 17% per year. Okay, if you want to do 10% per year, you need to have a cash from operation growing at 8% per year, even less, 7% per year. Okay, if cash from operation grows 7% per year for the next 5 years, you will do approximately 10% if you buy at this price. So it's really good. Let's say maybe instead of 17, we have 15 here. Okay, 12% growth, you will still do 12% per year. So with a 14% growth, which I think is achievable, you will do 14% per year. And if you have a reduction in the valuation of the company, instead of 17, you have 15. So yeah, I believe it can be a good opportunity. Like, yeah, it's a very fair price for Google. Like, in my opinion, under $180, it's already a very good price. But now at 160, 150, what is it now? 158, the value is even better. The price is even better. I might buy more during the month. I don't know yet. I don't know yet. I need to do some transfer to have some liquidity on the account. But at this price, yeah, it really interests me to buy more Alphabet. I think it's a great stock. I really believe in their future. I think they're well positioned in the cloud computing with YouTube, with Google. Like, it's a great stock, great quality business. Okay, you have amazing number, amazing margins, amazing return on invested capital. You have no debt. Like, the debt is paid easily. They do a bit of buybacks. They have a little dividend. I don't really know why they keep this dividend, but they have a little dividend. So yeah, I believe the company can continue to grow. I believe the company is still a great business. I don't believe this acquisition will have a bad impact on the long run. I still believe that 32 billion is too expensive, but yet again, maybe they really need it. Like, maybe they really need so much this company because they was not able to grow by themselves in security. They were not able to produce a good enough tech in security, so they needed to do this acquisition. And if this acquisition really helps them to secure everything with cloud, and they gain trust for customer in this, like, on the long run, it will pay back. The way they manage to scale everything and so on, it will pay back. So yes, right now it's too expensive, but on the long run, I'm not sure it's something that will affect Google. Like, they have so much cash that they can afford doing a bad deal at $32 billion.